Recording. Okay. Well, thank you so much for joining us today for TBLI Radical Truth. I'm honored to have as our guest today Aunnie Patton Power, the acclaimed author from Adventure Finance, who has been active from investment banking to helping entrepreneurs actually follow their dreams and find their big purpose and actually understand the whole finance space. So thank you, Aunnie, so much for doing that, taking time out for your work. So for those that are not familiar with you, your book, your work, your teaching, tell us a bit about who is Aunnie Patton Power and what is your big purpose?
Sounds great. Thank you so much for having me. So I started out in finance during the, just before what we called at the time, the Great Financial Crisis. We didn't know that there was going to be others after. I mean, I suppose we should have, but this was mid-2000s. And, I really fell in love with finance, but I really fell out of love pretty quickly with making big companies that didn't actually care about people a lot of money. And I often tell the story of sitting across from a healthcare provider, it's called an HMO in the US, that was trying to convince me to essentially build the model so that it didn't show that they weren't spending enough money on their patients. And I was just disgusted by that. And I realized, honestly, that I was quite good at finance, but I didn't want to be using it to do that. So I left in the middle of in 2009, in essence, when everything was falling apart. Everyone thought I was crazy. Kind of did a trip around the world trying to figure out what I wanted to do, and had been really inspired by Muhammad Yunus's World Without Poverty. And this was 2009, so the term impact investing was just being coined. And so people that I talked to just didn't know. Microfinance was the only thing that I could find, really. And so I ended up spending almost a year in India working for a investment bank for social enterprises that was at the time transitioning from just working with microfinance entities to actually working with social enterprises and helping them raise funding. So it was a great time. Amazing company still exists called Unitas Capital, based in Bangalore. And for me, that was really transformative, working with them and this emerging set of social enterprises and helping them to raise capital. And I realized very quickly that I loved this. This was, merging of, social interests and environmental, as well as my kind of geeky financial brain. But I also realized very quickly that these deals that I was doing looked exactly the same as the ones that I had been doing in Chicago and New York. And that just didn't make sense to me, because this was a whole new world. We were trying to build different types of businesses, but we were doing it with the exact same time of financing that we had built the other types of businesses. And so I think what I really started doing then, I mean, this was back 2010-ish, was just asking the question of, well, how should deals look? And what are the types of things we should be putting together for how we can fund this new type of businesses? What's the new type of financing that we should be doing to fund these types of businesses? And my journey on that has taken me a lot of different places. From India to the UK. I've worked in Ghana with social entrepreneurs and investors. And then for the past 12 years, I've been down here in South Africa. I work globally. I'm on faculty with an associate fellow at the University of Oxford. I'm also a fellow at the London School of Economics. I've written a book called Adventure Finance. I have a new initiative called the Innovative Finance Initiative that we're currently kind of in stealth mode. We'll be launching very soon, formally. And I also work with a group of high net worths with an organization called The Impact. So what I've tried to do now with my portfolio career is have an element of thinking and writing, kind of taking ideas and really trying to make them very accessible around how I and others believe that finance should be. And then I also do teaching. So obviously I teach both online and in person across both universities and others to really be able to make these ideas not just accessible, but people actually implement them. And then I do advisory work. And so really working on developing new types of financial instruments, new types of structures, helping family offices, foundations, large institutions to develop strategies that integrate impact into how they allocate capital, as opposed to just what they are investing in. And so that's kind of where I am right now in my work.
That's quite a Swiss Army knife that you're running over there. I'm curious on the teaching side at the university, are you teaching MBA students? Are you teaching economic students, finance, or basically policy geeks?
So it's actually funny. I have taught all of the above. So
Okay.
I teach MBAs, I teach executives, but I've been so I was a fellow at NYU for a few years, and I actually taught at the policy school.
Oh,
I've taught at the policy school at Oxford as well, and actually I'm at the at LSE where I'm a fellow. It is actually the Marshall Institute is also within kind of cross between the. So it is like a lot of times I teach executives generally, MBAs and executives, but mostly executives, and so the executives are a mix of foundations, families, lawyers, consultants, policymakers. I do a decent amount of work on the policy side as well, because it's a combination, right? There's private, public, there's different types of capital. So there's definitely a lot of variety in my classrooms, which I love.
and the uh, I have, excuse me, I'm often challenged by the fact that the ones doing the most talk the least, and the ones doing the least talk the most. And uh, when I speak to some family offices or they try to impress me, whether 20, 30 years ago when we started or now, about what they're doing, and I open the kimono and I don't really see very much over there. But because we follow the Groucho Marx rule of membership, we don't join any club that would have us as a member. Um, how do you deal with that? Because I can see that you're very passionate about this. This is not a side gig while you're, selling toxic waste. This is your big purpose. Yet there's a lot of asset owners, particularly among family office, who are flirting
Yeah.
with impact. How do you deal with those individuals?
So to be completely honest, Robert, I made a pretty big, I would say, switch in my own work a couple of years ago that I don't convince people why anymore. I just don't do why. Like I
Okay.
spent a lot of years in boardrooms at big financial institutions with families. This is why you should do this. I used to teach intro to, impact, all those things. And I just have said there are enough people that are out there that can do this. I teach how. And so if you want to, anything that I do, you need to be bought in. And I'm happy to create on-ramps for people, but I personally spend very little of my time trying to convince people to do anything. People come to me when they know that they want to do things differently, they want to integrate impact, they want to go beyond traditional impact investing, and that's when they find me. And so for me, it is very much about the most kind of radically impactful, inclusive instruments, allocation. Like I'm happy to sit at the fringe. I will continue to position myself at the fringe, which means that there are lots of people for which my stuff is just too much for them. And I am totally fine with that. I would much rather be in a room full of people that are questioning the entire capitalist system than I would be in a room full of people that are just looking for the next green deal so that they can, show a bit of clean energy in their, impact portfolio. Not that green deals aren't great, obviously, but
But so um, I get that, and I like that. I also try to not work with any extractive individuals and try to work only with non-extractive. But sometimes I've got to go through, somebody is at a certain level of awareness. And I always use the example when we were trying to educate asset owners in Asia. They always thought that in Europe, they gave me a big hug when we started 30 years ago. I said, oh, fantastic, great. And then I tell them the story about the Dutch insurance industry that asked me to speak about climate risk. This was about 22, 23 years ago. And I said I'm from Brooklyn, so I'm very pragmatic. I said, they're a country below sea level, the Netherlands. Sea levels are going to rise. I'd be concerned. And you know what the insurance industry said? It's not a problem for us if sea level rises. We don't cover saltwater damage. So you can get very upset at the crazy stupidity of that. But I realized that is the level of awareness where that person is. So there's no point in shouting in Mandarin to someone who speaks Swahili. So I said, yeah, but you give mortgages. So if 200,000 homes are underwater, you have a big financial loss. Then they understood it. So how do you, not everybody is at your level of non-extraction and want to get to how. They're at a certain point and they want to better understand, why should I bother, or why is this relevant? How have you been able to kind of navigate that to get them in speaking in the language they understand? The financial sector is just a bunch of alpha males that run up the hill and off the cliff at the same time.
My book has been really, really helpful. So I find that, 10 years ago when I was doing, these talks, and I had people come to me afterwards and be like, I really want to learn more. And I just would struggle because I could send them a few things, I could spend a little time with them, but I didn't really have, other than a few articles, maybe something, I didn't have a body of work that I could give them that could give them that entrance that would allow them to get to the point where then the conversation was how as opposed to why. So my book, Adventure Finance, which is really, as you know, a collection of stories around ways in which entrepreneurs should think about non-extractive forms of financing, so beyond debt, equity, and traditional grants. And so what I find now for me is that most of the people that I work with, most of the family offices, institutions, et cetera, have read the book. And so their questions are not, what is revenue-based financing or what is redeemable equity? Their questions are now, I've done this. Here's what our learning was. How would we do it better? What should we think about with recoverable grants versus forgivable loans? How do we think about integrating impact better into our interest rates? How do we think more about, really creating fit for purpose vehicles? And so for me, having that has been, and I have a whole series of videos and trainings and all the things around it so that when the goal being that when you need to go beyond what's in the book and beyond what's in the content, and I have a playbook that we wrote for the US government that builds off of it. I built a diagnostic tool, which Village Capital, that also builds off the book. So you can, as an entrepreneur, as a funder, go in, answer a set of questions, and it gives you the types of instruments that potentially would be the most applicable to your situation and more information on them. So really what I'm trying to do, right, is to scale without, I don't want to build a massive organization. That's not what I want to do, but I want to be able to scale the ideas. And so the book has been really useful. And I've been working on my second book for about 3 years now. The first one was quicker because COVID suddenly gave me a lot of time. And I didn't have a child yet. So I have a 3.5-year-old. And so you can get a lot more work done when you don't have a child. So I've been working on my second one for about 3 years. I'm hoping to finish the manuscript this year. And the first one's on deal structures, and the second one is on alternative fund structures. So looking beyond the traditional 10+1+1 closed-end fund structure, what are the actual ways in which people are innovating around strategy, around structures, around processes, and around incentives to really integrate impact. And then the third book, which I'll start as soon as I'm done with this one, is around market structures. So looking at things like publicly listed debt, bonds, indexes, what are the ways in which we can go to the next stage of having these products, market products, that actually have impact integrated. So I've always thought of it like that. So there's this trilogy that I was going to write, this pieces of work around deals, funds, and market. And so that's really, trying to do the work along the way. But that's really been kind of my like North Star, really. And I knew kind of almost a 10-year project, probably.
So you have a very clear North Star, very clear focus, until your daughter starts screaming, "Hey, I need some food," or whatever, and that disrupts the focus. And I admire that. I struggle a lot with when we started 30 years ago to try to change the financial system so it worked for all stakeholders. Um, ESG at that time seemed, wow, that sounds really cool, retooling the financial system and restoring the social environmental balance. Unfortunately, the latest the press release of Bloomberg saying there's 50 trillion going into ESG 2025 this year. If that was true, we'd have no problem with climate or any other problem. So what it's become is a fitness club where everybody wants to show they have a membership card, but nobody goes. So I mean, because as I said, this is not a day, this is not, you're not a day trader. You're all in. This is your future, and this is where you're advocating. So doesn't that frustrate you, the fact that people just want watered down Diet Coke?
Yeah, I mean, I think for me, what I've always seen, and I think ESG is a great gateway drug, but I I actually think in a lot of ways ESG has worked the way it's supposed to, right? ESG is about mitigating risk for the investor. And you can mitigate you can build a moat around your castle and not actually make any of the land around you any better. So I do think that the reason that we need impact and the reason that I personally think we need to push impact even further, which is what I try and do every day, is that I don't want us to look back in 20 years and be like, wow, we have 50 trillion going into impact, but the world still looks like, an absolute terrible place because everyone, I mean, I think your analogy with the fitness club is totally spot on. So we don't want everyone walking around congratulating themselves, patting themselves on the back that they have an impact portfolio when actually they're in a glass-walled house looking at all the world's problems. And I think that's where there's some really systemic issues that impact investing needs to address. And one of them is the extraction. So, one of the reasons I do not think the current financial system is what we should be replicating in the impact space is that the current financial system was built for the benefit of a few. You put money into the best meaning organization, you take that money back out when it has grown. And yes, you have created jobs, hopefully, wonderful. You've maybe made a couple of entrepreneurs wealthy, but you've not necessarily enriched a bunch of individuals. And so this is where I think impact investing has done a really good job of moving people that live in poverty from the poor beneficiaries to producers and consumers. Where it fails is to going from producers and consumers to wealth holders. So we're allowing people to buy health insurance, send their kids to school. These are all amazing things, but we are not actually pushing them into the just above poverty. They can buy things, but it doesn't mean that they actually have wealth or they have assets. And so if you don't have assets, you have no buffer. And so by not focusing on who owns assets, I think we are missing the way in which impact investing can be transformative. And I'm doing some work right now with a family that's incredible. It's the Delta Fund, is the name of the fund, and they are focused entirely on asset ownership as a way to essentially fight income and wealth inequality globally. And I think that impact investors, we can't just sit back and hope that a bunch of our VC funds are going to create technologies that are going to fight some of these ills, because that is not going to fix the world in general. It's not going to fix governance. It's not going to fix wealth inequality. And so I really do think that, exactly as you're saying, we don't want to be in the same place in impact investing that I think a lot of people like yourselves are in ESG, that saw the promise, wanted, like, pushed it, and it did. It scaled, it grew. ESG is part of the way the financial system works now, but it hasn't changed the financial system. And I think that's where impact investing, we need to not be thinking about how do we win in the current game. It's how do we change the rules? And I think if we don't do that, we're going to be in the same place that ESG is in 20 years.
We every time we did our international summit in Europe, Asia, Latin America, North America, I would always invite the impact frameworks or the ESG frameworks or the research providers or the rating agencies to come join and share knowledge. And I always got the same answer. They said, don't put me in a panel with PRI or CDP or that. They always said that. So last year I said, I'm sick of this. I'm going to launch a open source database index comparability of all the different ESG and impact frameworks.
Okay.
So we got 44 independent approaches. I mean, it was funny because the head of MSCI for ESG, he quit because he said, this is crap. And he created a model that only looks at one thing. They only look at the boards. That's the only thing that is their KPI. And Bonnie Lorraine Smith, I don't know if you know her, but she's like, you on steroids in outer space. She used to do all of the auditing of many, many multinationals on sustainability. She said, this is garbage. This is just fraud. And she says, is your company in service of life? Period. That's her thing.
Yeah.
So we, excuse me. So we did that, and we got 44 independent. You can go to the website, and then I'll send you the link, and you can watch 44 different ways of measuring that. But what was interesting, which I anticipated would happen, 100% of all of the well-funded large organizations that in the ESG and impact all refused to participate. So whether it was B Corp, PRI, CDP, World Benchmark Alliance, MSCI, S&P, EcoVadis, which got $750 million investment to measure supply chain around sustainability, they all refused to present because I think they just didn't want comparability. If you're going to buy shoes, you want to see how is this one, how's that one, and if you can compare, it makes it a bit challenging. And I agree totally with you. If we're going to be in 10 or 20 years the same thing, press releases during the World Economic Forum of Microsoft saying we're going to suck all the CO2 out of the air by 2050. And who's going to contact them when they don't hit that benchmark? These are meaningless statements. So I really admire the fact that, hey, dude, get out of my way. I'm going this way until my daughter calls me, and then I'll take care of her. But it must be hard, in spite of the fact that you do meet family officers, that, Aunnie, I'm serious, I'm not curious. But you still have to keep, how do you keep that fire in the belly to keep going forward? Because I'm sure there are days, oh man, this is ridiculous.
Yes. I would say I've had a few more of those in the last, say, 5 weeks than normal.
Oh, okay. Okay. Join the club. That's good to hear.
No, I do. No, but I will say that it's not obviously all sunshine and roses. And I've been around the block for long enough to be frustrated. And I think one of the reasons that I continue to be willing to push the frontier is because there are other people around that are also, kind of marching arm in arm. And I don't think you can do this on your own. But I also know that I feel incredibly privileged to have built a very good career in this and have worked very hard at a lot of things over quite a few years now. And I suppose there's the economist in me. I have a degree in economics, and the economist in me sees that as sunk cost. So I have to keep moving forward, right? So there's all of that is what it is, but it's until, you actually can show some of the changes in the system. And I think that's where it has been quite gratifying to know that, there's over 10,000 people that have, read my book and like have, started to implement some of those things. And it feels like when I wrote the book, venture capital was at its zenith, right? The market was, I mean, the book came out in 2021. The market was literally flying. Like, I mean, 2020, I mean, I finished it in 2020 and then it came out in 2021. And so to write a book that's first line is venture capital doesn't work for most enterprises at that time. It's like there's a little bit of craziness to that. But now, almost 5 years later, like so much of it just feels so common sense. People are like, of course that doesn't work for everyone. Of course. So like I do think it's like so far, like pushing that boundary like that, like I still have seen movement, not enough, and there's a lot of frustration right now with everything that's happening and watching a lot of good work get completely unraveled. But I do think the market and the world is moving in the direction of realizing that the status quo doesn't work. And so I think the imperative is the how, that like, okay, it doesn't work, then what? And like that's where I think for me, I continue to want to put my energy into the then what. Like what, like if like assuming that the world's going to come and assuming people are going to, start to realize that this isn't working, that it's going to be important to have alternatives because otherwise everyone can sit around and moan all they want, but nothing will actually change.
Well said. That's very, very true. I remember that when we started a long time ago, I would always get this question, Robert, do you have any research that shows there's no underperformance of sustainable investing at worst or outperformance at best? And I stupidly used to send all the research because there was loads at that time. And then I finally had the aha moment and realized this was not about proof, this was about belief, because I looked at how much research was done on subprime collateralized debt obligation as a risk. I'm sure some obscure university in Manitoba wrote something, but nobody read it, and all the money went. And that's when I stopped doing that. I didn't send any more, research about that, and focus what are the triggers to get people to believe.
Mhm.
Self-interest, opportunity, and money flows. Um, and but in your case, you wrote a book, a very successful book that seemed to resonate with some asset owners and I guess some asset managers and service providers, and maybe hopefully many of them changed their job and realized that selling heroin for a bank is absolutely, or an oil company is actually not fulfilling them. They're not getting that fulfillment. So it's very important that, the work that you did. Coming back to the part about the inequality, I look at the wealth reports each year, and I was kind of stuck with me. The last one before Credit Suisse went bankrupt, they were talking of 4.8 times more wealth than there is global GDP. Maybe it's 4.9 now, So, and investors always want market rate or market beating returns. When are we going to get to the point enough is enough? How much, dying rich is not an accomplishment. And I know that I deal with the financial sector, and they're hunters. Some are pirates, but in general, they're not farmers. So teaching farming to hunters and their clients want constantly more and more and more and more and more. Um, can we break that cycle of, do you need 20 times? Do you need 10 times? Do you need 5 times? What is enough for you?
And Robert, this is something that I'm doing every day. So I think,
Oh,
and I say that I am very, very lucky to work with a set of families that have sometimes publicly talked about winning at a rigged game.
oh,
Um,
that's wonderful.
and I think that, yeah, I mean, and so they are often asking, and this is where, the so-called impact first kind of community, which is not very well, I would say, organized, and something we were working
No,
on a lot. But people that are, I think there's a few different questions here. One is absolutely how much is enough, which is a question that some people are asking themselves. And I think particularly families, particularly next gens of families that are looking at this money saying, I didn't earn this. The way that my father, grandfather, great great grandfather earned this was reprehensible. What do I do to not just, some are saying, let's just give it away. There's others that are taking more of a, how do I think about investing this for maximum impact as opposed to maximum financial return? I think that's, for me, those are the types of families that I want to be working with to be able to, I think there's the possibility of building, on the one hand, looking at capital that does not and should not require market rate returns. That's the first piece. And so there's families, there's development funding, there's the things that are not essentially built for that, that should be looking at impact, that should be looking at development. And there's a wide range of different financial returns when you're just focused on impact. I then think the other piece is that there's two other pieces. Another one is around what is the market and what is actually the risk. So we have old risk models, we have old conceptions of what markets are. And so market rate return, you ask anyone what a good return is for a private equity fund, they will tell you, 20% plus, right? What percentage of private equity funds actually return? I mean, we're talking most venture capital funds do not return money to their investors, right? We know that. Like that is a less than 50% of them do. So the market rate is not 20+% for an alternative asset. That is actually not the market rate. And so I think there needs to be some real reality around what risk models actually look like and what market returns actually are, like realistically market returns. And I think thirdly, then I am a big believer in products. I think that we need more products that are sometimes very bland. I think having impact integrated into them is wonderful, but like we need more impact publicly listed debt. Historically, the impact market has absolutely they've done private debt and they've done private equity. And now, I mean, obviously there's public equity ways of doing impact, which I think are interesting. But the public debt market has really been very missed in the impact investing space, which means that most social entrepreneurs are either having to pay a private debt risk premium or a private equity risk premium, which means that social entrepreneurs are just like other small businesses, but even large social entrepreneurs that cannot access public debt are paying a premium to be able to operate. Now, that doesn't make sense to me. So figuring out ways to leverage public markets, guarantees, that's another way to leverage public market, like so using guarantee, I think guarantees are woefully underused, and I say this all the time, and still doesn't seem to be. Development institutions, governments, like can leverage these guarantees because we need to bring down the cost of capital. There's accessibility of capital and cost of capital. My biggest thing in the book, right, is that we have equated venture capital with risk capital. Risk capital does not necessarily need to be venture capital. In fact, most of the time it should not. How do we build varying types of risk capital and varying types of, more debt capital that do not require the venture capital premium? And this is where things like revenue-based financing, redeemable equity, using supply chain financing, using guarantees, building products that provide this type of capital, that use technology to be able to, better and more quickly diligence companies, allocate capital. These are all ways in which I think we need to take the premiums around social and around small businesses that are sometimes those risk premiums are justified and many times they're not. And we need to essentially realign those. So we have people that need to take lower return, not maximize return because their capital does not require that. We need to rethink risk and market essentially models and expectations. And then we need to build more products that better price and distribute that risk to be able to create lower cost of capital for organizations.
My better half did the most successful social enterprise in the second largest employment sector in the world, which is hospitality. Number one is small scale agriculture. It's like 1.3 billion, and hospitality 330 million. So she was a tour guide in Bhutan, an anthropologist, did her
Oh, wow.
PhD, and she built a vocational hotel school in Bhutan, and tried to do it as a for-profit. And everyone said, "Oh, smallest economy in the world. There's no money there, etc." So she did it as a nonprofit. It was very successful. 99% of all the students got jobs at five-star hotels, and then tried to replicate the same model in Myanmar, in the refugee camp, in the Karen state, and a few others. And nobody wanted to um, provide funding. It was not sexy. I mean, it was a huge benefit with very little money. You needed very little money.
Yeah.
And it was just not sexy. They kept saying, "Where's the app?" And she kept saying, "There's no Wi-Fi here." "What do you mean an app? There's no app. We're teaching food and beverage and housekeeping and barista." Um, so I get what you're saying about the products, but sometimes there are products that people, just they keep looking for this, how do we get rid of all of the farmers? How do we get rid of all of the food producing, and just, replace them with drones and robots? And what's the next Facebook? Where's the next unicorn?
But that's why we need products, because when you have just funds and they're looking for the next unicorn, and you have people that are, and I think this is where, like, for instance, one of the things I totally agree. I think nonprofit as a corporate ownership is something that honestly I've come full circle on, in the sense of 15 years ago, social enterprises should be for profits. We need to move away from, nonprofit mindset. Whereas now I've come full circle. I personally believe that there should be, in some industries, there should not be non-nonprofit, for profit, or non-social enterprise ownership of, some areas in healthcare, some areas in education, etc. Creating a set of stakeholders that are not distributed stakeholders, that are concentrated stakeholders that are profiting from some of the, like, I don't think that business models necessarily, but your wife's business sounds like the right type of business as a nonprofit. Just means that she didn't distribute, and they have to, push her prices up to be able to distribute capital. So I do think one of the reasons I think products are so important is a product I would like to see built globally is mergers and acquisitions product, essentially a SPAC takeover for nonprofits. So low cost funding to go into healthcare, to go into education, to go into some of these areas, buy out for-profit entities, have them as nonprofit essentially holdings with low cost low cost debt to go into that. That's a product I would love to see, because you give enough people options to be able to have a low risk, low returning, very social product. I do think people would go into it. You give fund managers the option to do that. You don't always, fund managers are going to be like, I'm not going to make the most money with that. So you have to find ways in which, in some ways, we need to unsexify some of these things. Like, that doesn't have to be sexy. But I
Mm.
think that's where some of the I think that's where some of these products beyond just kind of traditional funds are really important, because they're able to build much more stock standard. If you have these criteria, you can access this fund, as opposed to you need to be sexy and have a app and be, a Facebook, and there's some kind of intangible.
There's actually a fund along those lines in the United States, but it's only because of the weird healthcare system in that country. It used to be called Rest in Peace Medical Debt, and
Okay.
now it's called Undo Medical Debt. And I did an interview with the founder. It's a very simple idea. It's a nonprofit. They buy medical debt
Oh, I've heard of this. This is on John
particular.
Oliver, right?
No, Allison Sesso, Allison
Oh, okay.
Sesso, and they buy the medical debt for pennies on the dollar, because the hospitals want to get it off the books. We're not talking about
Yeah.
millions of dollars in debt. We're talking maybe $10,000 or 20,000 from a working class family that can't
Yeah.
afford that. And she'll call the individual, say, you're home free, your debt is gone. So she's leveraging, very, very little to a lot, but it's only works in the United States because they have a screwed up system over there. And I told her I never understood that you would even need something like that because it just doesn't exist in that. But there's an example. It's mainly to eliminate medical debt, but and she gets lots of donations because it's very effective. She can show, for every dollar we can get rid of 100 in debt.
Absolutely. So, but here's the thing, and this is where systemic thinking is important. That kind of thing, great, awesome. It is a band-aid on a bullet hole,
Oh
right?
yeah, yeah.
System needs to change. And this is where I guess my point was more, I don't think private equity funds should own the hospitals.
Mm.
I don't think private equity funds should be owning the nursing homes. I don't think that, and this is for me relatively new, I have decided that in general, I think that they are pharmaceutical companies, et cetera, the pure profit-seeking models within healthcare and other service areas, I think are creating this massive issue. And that's where I would love to see some big funders come together and put together funding to be able to buy out some of these investments, buy these nursing homes from these private healthcare, private equity funds, et cetera, and run them as nonprofits again. Same thing with financial institutions. I think there should be more nonprofit financial institutions that are running them for the good of the the customers, right? And that's where if you can create, I think this is more a business model versus a financing thing, but then there needs to be financing for these nonprofits. If you can create the ability to run a very successful businesses that are nonprofits, the NFL, FIFA, nonprofits, those are very well-run businesses that do not, attract tons of money, right? There's no reason, we're not holding those up as very good, well-run organizations, but there's no reason you couldn't have more nonprofit like large organizations that exist purely to benefit the end users. And that's where if the only way that happens right now, because the system doesn't work, is to have large amounts of capital that are willing to fund this transition and to sit over longer periods of time with lower rates of return to be able to fund some of those transitions. And I don't know, I'm working on that, something that I hope to do.
I don't know if you're familiar with Leilani Farah from Make the Shift. She was a
Yeah.
UN rapporteur. She is focused on doing that for the housing sector. So
Really?
basically, yeah. So she's not an investor, not a finance person, but shining a light on the PE firms hoovering up all of the mortgages that went, bust, kicking the people out, and then raising the rent. So, and she does a podcast weekly with a Swedish gentleman, and she did a beautiful documentary about the housing crisis. That there's no shortage of housing, but the model is completely messed up. You might enjoy that, Leilani
Yes,
Farah,
absolutely.
and happy to connect you with them. And there's another group, another non-sexy group called UITP, which is the
Okay.
Union Internationale de Transport Public. So it's the 1,500 public-private partnerships in public transportation. And they have to raise $2.3 trillion every year. Only one public transport system really makes money, which is the Hong Kong. And we try to work with them of trying to access the capital market because they are the easiest way to decarbonize your portfolio because they're AA rated, steady cash flow, no technology risk, but very boring. No asset manager ever says, hey, we should invest in public transport infrastructure. And the way they raise money is they raised 500 million for buses in Hanover. They go to Commerzbank. Commerzbank cuts and pastes the bond from the last time and goes back to the same investors and charges several $1 million. So we tried working with them, but UITP is just in a member association. They don't actually do that. So that's an interesting one. And one thing that you might find helpful, we're launching a kind of glass door for the VC and PE space
Okay.
where people can rate what it was like, because what you have now is a lot of entrepreneurs and emerging managers, they make out on the couch with the VC for 6 months, no sex, and then they're ghosted forever. So we create a code of conduct and our onboarding that and reaching out to all of entrepreneurs. Just post your review, and that will help LPs to pressure those VCs and do a better job. Because I found that some of the largest fund managers, and that could be a family office or that can be a PE firm, have great social skills, respond quickly and say, I'm sorry, it's not for me or that. But there's a lot of really bad actors. It was funny when I was announcing that. I got like 99.9% super enthusiastic from emerging entrepreneurs, except for one fund. And that was a European investment fund who tried to intimidate me, frighten me, threaten me, seduce me not to do this because they use public money. They're the largest funder of bad actors, and they're very political. So I agree with you on the product side. I don't think there's any shortage of solutions. I think there's lots of that, but I find the challenge keeping the spirits high to keep moving the ball forward.
It's a fair point.
My biggest challenge is not convincing the financial sector. It's convincing my wife that we're on the right path after 30 years. She says she hates finance. And I once had lunch with a friend of mine from public school who worked at Cantor Fitzgerald. And she asked him, what is the fun of trading money? And he said to her, don't you understand? You make $1 million in 5 minutes. And she said, I repeat, what is the fun of trade? And I saw it was just
Good.
not on the
That's
same
good.
on the same wavelength. How can we help you?
So I would say a couple of things. One is I have this new initiative that is launching. We've done some soft launches. We'll do an official launch at the end of March. It's called the Innovative Finance Initiative. It's really aimed at asset owners and technical experts that are building hard things in impact. So all the people we've been talking about today, we have funding from some of the major foundations and a lot of family offices in the space. And we really are just inviting asset owners, technical experts. We also have things we're building out for fund managers as well. But what we're really saying is if you're doing things the rest of the market tells you that won't work, like come to us, because we're building a community of people that are doing that, building tools for them, using technology, mapping people that are doing this, doing connections. So it's called the Innovative Finance Initiative. There's nothing, I mean, there's a website that's like a dummy website right now, but it'll be launching at the end of March. So I'd say come, join us in doing that.
So
And then
it's a think tank and a community.
Yeah, so it's an initiative, 5-year initiative. Goal is to map, connect, convene the fringe of impact investing. Really, the ultimate goal is to try and wrench the impact investing space towards impact and out of get it out of the line that we're talking about the 20 years from now, what on earth have we accomplished kind of phase. And so we're really trying to bring some visibility to people that are building what we think the market should look like, not just what the market will accept.
And when will this be officially launched?
The 1st of April.
Oh, okay. So very soon.
Yeah, we've done soft launches. We actually did another soft launch last night. We had about 80 asset owners, technical experts, etc. We've been doing like onboarding with our community. So we have about 200 people from most of the kind of large pools of wealth and experts and funds that are really kind of in this fringe area. And then also there's, if it's useful for anyone in your audience, I built a careers platform. It's called Impact Finance Pro. That's often useful for people, lots and lots of people looking for jobs right now. The platform's doing a call for development professionals that are, struggling right now. And then I would just say, my biggest thing I always say on these things is, I just really want people to be courageous. Like now is not the time to be cautious. It's the time to be courageous. And I think for a long time, the market has dictated what is possible in impact and sustainable finance. And I understand why the market is very powerful. But I do really believe that no matter what type of assets you have, you can make bold choices with them. and also with your time and with your resources, and just not accepting the status quo. And I think that's, if we have more people that don't do that, they won't be able to build a market that actually works, as opposed to one that is just replicating what
I
has.
I totally agree with you. Over the years, I never found the convincing challenging. The challenge I always found was access. The more money somebody had, the more
Yeah.
isolated they were. So
Yes.
Bezos doesn't have a sign, "Hi, I have billions, come visit me." And so I never really saw that as a challenge. And I remember I was talking to a Dutch CEO of a reasonably big endowment of 500 million. And he said, I'm going to start doing impact investing and sustainability. I'm going to make a lot of mistakes, but I'm going to start. So he asked his wealth manager, let's get started in doing something. And the wealth manager said, no, 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 don't do that. You're going to lose lots of money. Bad idea. So he said, okay, I'll go find a wealth manager that will do it. And all of a sudden,
Yeah.
that wealth manager was happy to do it. And every year he did a little bit more, a little bit more. He tried experimenting with that. And he came back to me, I think after 5 or 6 years. I said, Robert, it's really not that hard to do if you want to do it, but it's really hard to do if you don't want to do it. And, I always kind of kept that in the back of my mind when I'm speaking to asset owners and that. Um, and then you meet a great family that is actually serious about this and wants to do that and has the courage. I don't know if they have the same amount of courage that you have, because you're quite fearless in staying the course. Because it's not a big organization. You don't have 500 assistants, carrying on everything. I see that you're driving this, you're rolling a stone up the hill while everybody is putting oil slicks on the hill and pulling you down. So I admire the fact that you're doing that. So anything that we can do to help you, please don't hesitate to ask. And was there something that you felt that was very important about your work that we didn't speak about?
No, I've enjoyed this conversation. Thank you so much.
No, this is also great uh, for me. It's so nice to see not only people, digging the hole and not just cutting the ribbon, but actually having other asset owners who are serious about this and moving the needle. I meet too many extractive people that just want to kind of shave off the corners, but not really make a new table.
Yeah, I agree.
Thank you so much.
Thank you. It was lovely to be here. I really appreciate the invite.
And my pleasure. And I'll let you know when Sam finishes. I'll make a short intro. If there's anything that you want when we put it out there for a link to the
Yeah.
Innovative Finance Institute, it'll be innovativefinance.org or something like that.
Innovative.finance.
Oh, innovative.finance. Okay, great. Aunnie, thank you so much.
Thank you.
Speak soon.
Okay, bye.
Bye.